Pension Playpen Coffee Morning. We're delighted to introduce you to Andre Kerr and James Kidd from XPS, who are going to talk about the wonderful world of Illiquids and a platform that they have now launched. And obviously, they'll present a few slides in usual fashion. If you'd like to raise a hand, please do so at any time. Andre said that he's very delighted to take questions at any time. Let's keep this interactive. Let's debate. Let's ask probing questions. Let's encourage Andre. Let's attack Andre, and in the nicest possible way. We are being recorded, so everybody happy with that? Everybody thumbs up. Andre, James, Chris, Elspeth. Thumbs up. Yeah, good. Okay, so we're being recorded. And as I say, we'll open the chat up as well if you want to make any comments in the chat. But without any further ado, I will pass to Andre, and I think James is going to present the slideshow. So over to you, Andre and James.
Excellent. Well, thank you very much, Steve, for that introduction. And as Steve said, look, please do ask us questions at any time. James will bring the slides up and share his screen. I'm Andre Kerr. I've been at XPS for a number of years, and one of my many responsibilities is heading up our liquid broking office with Jordan Harrison, both partners in the investment team. So like most things, we've named it with an X in it for XPS, so it's XPS Exchange. Really, we've designed the concept based on 2-3 years of work helping clients sell and buy liquid assets. And what we're aiming and attempting to do with XPS Exchange is not just help schemes sell liquid assets as they get close to their end game, but importantly, help schemes take advantage of the depressed prices that they are seeing in illiquids and buy them for those schemes that are either poorly funded or have a longer time horizon, or if they're fortunate enough, still open and have got many years to run before they get close to buyout. I'm going to try and bring things to life with a few case studies. But before we go into how we help our clients buy and sell assets, James is just going to go a little bit into what is the secondary market, who are the main players in the secondary market that ultimately we work with to help facilitate transactions in that place.
Thank you, Andre, and morning, everybody. Hopefully you can sort of start to see the slides on screen. So yeah, I'm sort of part of the team at XPS. I'm an investment consultant here in Birmingham, and I've sort of been on the team and actually helping for the last sort of 24 months, as Andre said, that we've been doing this sort of work. So the secondary market, it sort of allows participants to trade liquid assets. So in a similar way to sort of trading secondhand cars or houses, the secondary market it's there for that exact reason. And it was formed in the sort of 1980s, sort of 1990s, and it was originally only ever used if sort of a fund manager had significantly underperformed relative to expectations. So investors didn't ever really use it for anything more than simply they were disappointed. But in 2008, institutions needed liquidity, and the market started to sort of increase a lot in size. So it went from being about sort of the 5 billion to 10 billion point in 2008 to now, depending on who you ask, around 130 billion this year. And that sort of big increase that we're seeing in size, it's coming from sort of a wide range of diverse buyers and sellers now using the market. And it's for all various sort of different reasons. So obviously, as you'll be well aware on this call, obviously pension schemes are now starting to turn to it for seeking liquidity if they're de-risking. You've got a lot of secondary fund managers out there who have sort of raised large amounts of capital from all their investors, and they're now trying to find opportunities and buy them. And as you sort of look through the list, you've obviously got there's a lot of sovereign wealth funds now exploring the industry, and I know some of the sort of big Australian supers are now sort of looking out into the market. So a lot of wide-ranging participants that we've got there. And what this now means is that from whereas the industry typically was largest in size in the United States and typically private equity, we're now starting to see a lot more participants in sort of Europe and Asia, and it's not just private equity they're selling, it's now sort of private credit, infrastructure and real estate that's being frequently traded. So we're now sort of at a point where there's a lot of assets being sort of turned around, and there's a lot of good opportunities. And that's sort of what we're trying to help do now, with pension scheme trustees, trying to help everyone identify these opportunities and sort of make the most of them. And so far, as you can see, sort of from the chart in the middle, it's kind of intermediated with brokers and investment advisors. In a typical way to sort of buying and selling a house, there's a lot of legal input that goes into all of this as well. So we're sort of, how we're able to help with this offering is just our whole network of sort of legal advisors, brokers, other buyers out there to actually help identify these opportunities, and sort of make the most of them for our clients. That was it in a really short sort of introduction. Obviously, we welcome any questions, but I'll move on to Andre, who will actually talk about what Exchange actually is.
So XPS Exchange, and we've got 3 pillars of success. There's potentially more pillars that will come with more innovative solutions, sort of with banking, finance, etc. But primarily on the left-hand side, under pillar 1, traditionally, the only way that a pension scheme or even another asset owner of an illiquid fund could possibly sell it was to use a secondary market broker. That was a traditional route that schemes would use, but that route and approach has its limitations. You're limited to the network of the broker. The broker fees could be quite prohibitive, and there's some sort of legal aspect in terms of the documentation establishing the contract with the broker. But ultimately, it's only going down one avenue. But that was very much a tried and tested route. It's something that maybe 2, 3, even 5 years ago, schemes looking to sell on the secondary market moved away from illiquids to just primarily be using a market broker. And there are a number of brokers in the marketplace as well. So again, it's about trying to find who is the right broker that you can get you the best deal or the best fees on what they're selling. Now, more commonly, there's also pillar 2, which is using secondary fund managers. So these are managers that will hold funds, that will buy assets and holdings in funds that are reaching the end of their life. So it could be a private equity manager that their closed-ended fund has a 7-year period, and at the end of that period they need to return capital to their investors, their fund holders. A private equity manager isn't going to do that and sell all their assets if they're performing at a discount. So what they'll do is they'll transfer them either into another fund or to a secondary funds manager who can manage those assets on. Those managers are quite happy to take performing assets and funds, and often secondary market brokers will be selling, their clients will be the secondary fund managers. So by going direct to the secondary fund managers, you cut out the middle person, potentially getting you a better price and reducing fees, but it does add more complexity into the process. The third option and the third pillar for selling assets is a direct sale. So matching buyers and sellers. So for example, we might have one client that's wanting to sell an asset and know that there's another client that wants to buy it. So matching those two up, agree a fair price, and again, you can reduce fees and get a better price. And I'll come to that question in a second, Steve, thank you. Again, the difficulty with that is knowing actually for a client that wants to buy something, what do they actually want to buy? What's the purpose? And does that match up properly with the seller and any sort of moral hazard that can create? When we think about helping a pension scheme or actually even a different type of client sell an illiquid asset, we think there's merit in looking across all 3 pillars with a little bit of phasing, but pretty much at the same time. And that's because it gives you a wider opportunity set, potentially gets you a better price and better fees. And when we look at what is success under those 3 pillars, The best analogy we can use is to selling a house. Sometimes if you're selling a house, you might have 3 different potential buyers, but those buyers all come with different restrictions and limitations. So one buyer might not have a chain, somebody might be a cash buyer, and frankly, you might not like the third buyer because you don't think they're going to look after the house that you've loved and reluctantly are going to sell. All those things are still true when you're selling an illiquid asset in terms of parties that want to work with each other, the complexity and time needed to transact, and the fees involved, whether it's legal fees, whether it's fees of custody, etc. And ultimately, the best price. So it's not always the best price that is the best deal. And it's about assessing across a number of different factors to understand, when you've gone through the 3 pillars, which is the best route to market, which gives you that best overall solution, and ultimately the best value for you as a seller. And we do this slightly differently on the buying side, and James will go through. So Steve, I think you had a question first, and then I think Padraig's got a question.
Yeah, no, we'll go straight to Padraig. That's all right. Yeah, well, I think you've answered my question, but yeah, go on, Padraig.
Okay, thanks, Steve. Yeah, given I'm not an expert like most of the people in this room, can you just clarify this for me? Are you telling me this is a normal market for operating liquids, or is it essentially always going to be a market for distressed assets or distressed sellers because they haven't been able to sell them previously elsewhere?
Yeah, great question. The market has sort of expanded in recent times because of pension schemes needing to sell. But this approach isn't just for pension schemes. It could be used for anybody that holds in a liquid asset, a charity, endowment, sovereign wealth fund, family office, etc., insurer, and the same for buying. If we go back, say, 5 years ago, there were a number of schemes who would hold things like long lease property. And to buy an investment in long lease property, to buy into a fund, because of stamp duty, there's quite a lot of costs. And normally it would cost you anywhere from 5 to 7% that you would take a hit just to get access to that asset class. But pension schemes would buy it as a long-term investment because it had good, stable returns, normally protection against changes in inflation, good, stable tenants, and you'd hold it for 10, maybe 15 years. As those schemes de-risk, they might look to sell it, and they would typically go to a secondary markets broker and sell that fund at net asset value or sometimes a premium, because pension schemes or other owners would be happy to buy that holding at a premium because that was better for them than buying it and incurring the costs if they did it directly. So there's always been that market. There used to be 3 secondary markets for some assets where you were doing it to sell assets at a premium and you were buying them at a cost that was less than all the taxes, etc., that you'd have to pay. I think more recently, it's very much that the assets coming to market are at discounts to net asset value. Some of those discounts are pretty eye-watering, and if you don't go down the widest approach possible, you potentially can be talking 10, 15, 20% discount than you need to actually get in reality, which is not an immaterial amount of money when you're talking about reaching buyout and the end game and someone having to plug that gap. So corporates, the sponsors, as well as trustees, are quite interested in how they can get the best value from the assets they hold and no longer need.
Sorry, just to come back on that, if I may. But surely that I don't see why that would necessarily operate within this as a secondary market and not generally. If somebody needs to sell something, they're going to sell it at a discount, aren't they, to NAV? If they need to sell, are you saying then that this is more like a kind of closed market of gentlemen who appreciate the true value of an asset and will pay a fair price, rather than going out into the market where all the sharks are driving the price down because they're going to compete because they know that the owner has to sell?
Yeah, so some of that. there are not all pension schemes need to sell at any cost. There are other mechanisms for them to be able to hold the asset. So one example could be to do what's known as a deferred premium with an insurance company, where effectively they hold the asset for a number of years and get a loan from the insurance company before they have to buy out. That comes with costs of interest, the costs of borrowing, but that can be better than selling at a too distressed price on the secondary market. There could be the ability to sell the asset and transfer the asset to the sponsor. That comes with lots of other complications, either on the legal side or the company setting up a custodian side, and again doesn't come as a costless option. So pension schemes potentially is a bit of sort of consulting in this, have quite a few options to understand, and before they face off to the market to say what do we sell at. But you're absolutely right. If you come in a position and somebody knows that you're desperate to sell something, your negotiating power falls away. You also want to make sure when you're approaching the market, you don't inadvertently make that asset appear in the market more than once, because if you do, that naturally draws down and lowers the price. So it's your points are really, really valid. I think that goes to highlight some of the sort of the complexities that go into selling and making sure you get the best price, because in a lot of cases, the sellers aren't in the strongest negotiating position.
Okay, thanks.
So James is going to go. Gone. Yeah.
Sorry, Andre. Can I just, following up on Padraig's point, I'm not an investment specialist. It's interesting you say multiple asset classes and that sort of stuff, because for pension funds, there are always going to be various tax implications. Income tax, capital gains tax, dividend tax, whatever the tax is going to be. I mean, who sorts out the tax differentiation between outside of pensions and inside of pensions? I mean, is that the role that your platform provides, or that's a specialist consulting role that's added onto this, or what?
So for pension schemes, the tax issue isn't really there in terms of, because of how they're set up and their tax statements, tax status. The taxes that they pay would be more sort of the stamp duty costs of buying property, etc., which is unavoidable even for a pension scheme. But the tax implications come through if they were looking to transfer potentially that asset to the sponsor. And it's more on the sponsor side, and that's where the legal costs and the operational costs of a sponsor holding a liquid asset or an asset of this type can become prohibitive. And that's where typically in our experience, the transfer of the asset to the sponsor only works for either sort of the larger sponsors or the most sophisticated sponsors, because to do that routinely, I think it would be too difficult, too costly for most sponsors to be able to take in a liquid asset from the pension scheme. Again, that's where the legal advice comes in, and again, it's getting the legal advice that is proportionate, that helps directly with the question.
Okay, thanks.
So James is now going to cover a case study on the benefit of a pension scheme buying an illiquid asset. And there are lots of pension schemes that can benefit from buying a liquid asset, so they're still in that position where buyout is a long way away, or they're still open, or even they're not considering going to an insurer and buying out. They're happy to run the pension scheme on in sort of perpetuity, or certainly for the short or medium term.
Thanks, Andre. And yeah, of course, obviously on this call, we'll all be well aware of the sort of general de-risking of pension schemes, and think how does that sort of fit in with the liquidity of assets? Well, actually, sort of buying liquids on the secondary market has sort of significant sort of opportunities just for the sort of medium to long term investment strategy. You don't have to be sort of dead set on doing run on or some sort of long term investment strategy. You can actually have sort of a 5 to 10 year investment sort of horizon and still have sort of illiquid assets might be suitable for you. And the sort of the reasons that we see them being really attractive and good for these sort of pension schemes are sort of the 4 reasons that you got in front of you there. There's obviously the sold at a discount sometimes, and sort of going back to the distressed point, sometimes it's not the assets that are actually sort of distressed or have any issues. Sometimes the sort of the structure of them means that they can't be held by sort of certain investors in the market. So as I sort of said, normally sort of secondary managers are quite a large sort of investor. There are certain fund structures out there that secondary fund managers don't preferably like, or sometimes they can't even hold. Sometimes they're sort of like an insurance contract, that how they're structured, but pension schemes can hold them, and so what that means is you can sort of get the assets and invest into the funds at sort of a market that's disjointed from where it could be, and if the market was sort of more efficient. So if you, for instance, had sort of about a 10 million or 20 million pound fund available, you can pick them up at sort of 20% discounts to invest into. The other 3 are shorter investment life. Obviously, I'll come on to it later, but if you were to typically invest into an illiquid asset, you'd have to do it through a primary market. So you'd go to a fund manager, say, I want to invest £10 million into the fund, and then they'd have sort of a 10-year fund life cycle for the first few years, go out and invest into those opportunities, and then the rest of the sort of 7 years, it's managing those funds and eventually returning the money back to investors. Because you're buying it on the secondary market, part of that life's already gone, so there's actually a much shorter investment term, and you're actually sort of in sort of juxtaposed to how you'd expect, you're actually picking up something more liquid on the secondary market than what it actually might be if you were a primary investor. And the final 2 are distributing capital. Typically these funds, because they are in later life cycle, they're starting to return cash a lot sooner, and enhanced returns due to a liquidity premium, as I'm sure you might sort of be aware, rather than because you are sort of committing to having your cash locked up for a little bit longer and you can't immediately realize it for cash, there is a sort of expected increase in return purely from it being sort of not accessible as much. This kind of brought to life on the next slide, what I was talking about. So this is showing the actual sort of typical life of a closed-ended fund, and you can see if you were a primary investor and just went to a private equity manager, you'd be investing here on year 0, and at that point the fund manager would look for investment opportunities to invest into, and eventually the life of the fund and the assets size would increase. You then get to the point that's the harvesting phase, which is phase 2. So at this point, the manager, they're not actually selling any of the investments, they're just sort of managing them, taking off any sort of cash or profits, and typically reinvesting them back into the fund. And then what you find sort of as the fund starts to mature and gets to sort of the end of the 10-year life cycle, that cash starts to be returned to investors. And it's this sort of phase 2 and phase 3 where the secondary investments are sort of taking place and we see the best opportunities. And you can see the sort of extra benefits here rather than being a primary investor. Mainly because, one, you actually know what is underlying in the fund. You know exactly what companies are there, or you know exactly what sort of private credit is underlying it. There is no cash drag. So if you were to invest into it into phase 1, obviously the fund's not immediately at peak investment size, and you've got to hold cash back for when the investment manager needs it. You don't have that when you're buying on the secondary market. You immediately buy the fund with the money you want to invest, and it's gone to work and generating returns straight away. And the final thing is, sort of during the wind down period, you're going to realize quite a lot of that cash quite soon. So you're going to sort of have quite a lot of investment returns. And for a pension scheme in particular, if they're quite mature and have pensions that are due relatively soon, all of this cash that's being returned can be used in the future for meeting those pensions that are paid. If there's no sort of questions from that point, I would just sort of touch on a case study and actually sort of a real life example of a trade that we helped a pension scheme complete at the end of June, just to help sort of give a bit of colour and understanding. So this is a pension scheme that they're sort of targeting full funding on buyout equivalent basis, sort of early 2030s. So they got about a 5 to 10 year investment horizon. They're going to be cash flow negative in sort of the next 12 months once company contributions cease. And they had a lot of liquidity sort of after the gilts crisis. A lot of their portfolio is sort of sold and put into cash just to sort of batten down the hatches. So there was a lot of liquidity that we could use there. So for this client, they had about a £15 million deficit, and we were trying to help them close that over the next couple of years. And we identified an opportunity for a secondary market broker for a £7 million private credit fund. And this fund wasn't, for the reason that I sort of explained earlier, wasn't particularly liked by other market participants because of its structure. So we were sort of able to identify it and buy it at quite a significant discount to NAV. There's 20% of NAV. And so what this was able to do for the pension scheme was realise an immediate £2 million funding gain, simply because you're buying something at a discount and then realising it at full value. And also because it was a private credit fund, there was a lot of the good opportunities there I talked about. Of we know it's going to generate a lot of cash flows that'll help the scheme when it's cash flow negative the next couple of years, and also it'll help reduce the timeframes to actually meeting buyout, just because of it being a higher returning asset than what the cash was originally invested into before we did the trade. That was the sort of case study, how we all cover. So welcome any questions, or we can move on to the selling part, because these do come hand in hand.
Yeah, James, just looking at the time, if you move to slide 12, please, and I'll cover the question that came in the chat as part of that. In terms of the question that came in the chat about, is it more like a car dealership trading part exchange vehicles and taking them to auction? In some ways, yes. And in the case of buying and buy out, insurers are still very reluctant to take liquid assets because they don't want to have that burden, and they don't have to. They are, unless it is a absolutely massive deal that they want to do, they're in a position where they can just say, no, we're not taking them. They still might want to buy assets that they want to hold within their portfolio, but they don't want to have lots of odds and sods there that are very small holdings that are sort of meaningless. In terms of a timeline for how long it normally takes, we set it out here in terms of it's probably about a 3.5 month process. I think ultimately the first thing and most important thing is understanding sort of what are the objectives, what are you looking to achieve in terms of price, timing, what are the options. And actually in some cases the client has come to us and said we want to sell these liquid assets. We've looked at when they were expecting to transact in buyouts and said, actually you don't need to sell it, you are better off at holding that asset, because by the time you come to buy out, effectively it will have paid off, or the amount will be so small, and there is the funding impact of transacting on the secondary market or others isn't worth it. In terms of stage 2, probably the most important stage, it's the discovery on prices. So looking at what are the different options and helping trustees see not just what the price is or the range, and normally the price isn't a single number, it's a range, so you have to have a bit of a confidence interval. Some ranges are quite large, some are maybe 30-40% difference in NAV from best to worst, some can be quite narrow. Understanding what is the NAV, what are the other costs involved, what are the other associated fees that you might have, what's the governance burden and time frame to transact, to then narrow that down into a shortlist. All of this is done under non-disclosure agreements, to make sure sort of the client name, the asset is protected and doesn't appear. There's also a little bit of weeding out because some managers won't sell their fund to certain secondary fund managers because of sometimes very clear business reasons, other cases because of personal relationships. And the final stage is sort of the negotiation on price, going through the legals and ultimately the transaction. And just quickly looking at the questions. Yeah, so the auditors.
No, I was going to say that the Podreg has put a query there regarding the analogy about selling a house. Do you want to look at that one first, and then we'll go to Derek's point, and then perhaps to Stephen's? But yeah. So I've got that in that order. Sorry.
Yeah. Hopefully, I covered that in the explanation of the selling. Patrick's nodding. Perfect. So Derek's question about the auditors. So I think for the auditors, it's the same in terms of having that independent valuation process, and the net asset value should be sufficient for that revaluation. We've not discussed with different auditors on how we'll treat the asset coming as a discount and then being revalued at NAV, and their degree of prudence that they would accept within that. But in terms of the valuation sort of for funding levels, I think that should be sufficient. And generally, the assets are performing assets, so you've got more certainty over that value than you would do in the earlier life of a fund, as shown by James. Stephen's question about defining the discount. Yes, credit risk should be priced in. So some funds that have gone to market, the reason there's a big discount to NAV is because you've got visibility of now what's being held in the fund. So it's invested, you know the loan. So a private credit fund, you know the loans, you know the companies, you know what percentage of loans are distressed. Some of that should come through with the actual net asset value from the manager. Others with big discounts to net asset value will be because other managers actually are saying that fund has got a lot of problems, therefore we think there might be defaults, and they'll place a bigger buffer on that, so a bigger degree of prudence. So I think secondary fund managers, in terms of structure of fund, they've been pretty open to private equity, private debt, infrastructure. I think it very much depends on the nature of fund. Different secondary fund managers have different specialisms, whether it's real estate debt, whether it's infrastructure debt, private equity, or private credit. And again, it's them finding the funds that fit with the funds that they are launching, and a little bit of luck in terms of timing. It's absolutely not a product for XPS clients. It's a product for any pension scheme, any other different type of institutional investment asset owner as well. Thank you, Catherine, for that question.
Is that Catherine? Does that answer your question, Catherine? Do you want to unmute?
It does, yeah.
Establish?
Cheers. No, that really answers my question. Thank you.
That's excellent. Okay, cool. Excellent. Are there any other questions for Andre or James? I mean, before we see some more hands raised, which no doubt we will, and we'll also see if young Henry Tapper wants to say a few words. My question is, where does this go wrong, or have you come across situations where this goes wrong, and why does it go wrong? Yeah, obviously it can't be perfect, Andre, but you know, what are the pitfalls?
Yes, I think the first pitfall is that moral hazard that I alluded to, where actually selling might not be the right thing. And then the other area that needs to be understood from outset is, if we have one client that is looking to sell a fund, and we know through relationships somebody else that might want to buy it that isn't a broker or a secondary fund manager, it's more that direct sale, that third pillar. How do we ensure that the end result is best for both parties and not best for XPS? And so that requires a sort of a conflict policy, Chinese walls, separation of teams, independent peer review as well, to make sure that all of that is followed. Typically, when we help schemes, we operate under two different pricing models. We can either operate under a fixed fee, or we can operate under a model that involves a fee, a fixed fee, and also some form of measure of success. That model we do not use if we are acting on both sides, because that would increase the potential for conflict. Chris, did you have a question?
Yeah, Chris, you want to unmute, Chris? Yep.
Cool, thanks. So yeah, that was really interesting. Thanks, Andre, James. And I was just thinking, in terms of the the new scheme funding code coming out and things, and the sort of focus on reliability periods and kind of how long you can trust the employer for and stuff like that. Have you got any feel for how that is likely to affect how liquids are used in sort of scheme funding at all? It looks like the secondary market might help that quite a lot in terms of making it a shorter kind of period that they're around for.
Yeah, and I think a lot of the difficulty when we ran a session yesterday for some trustees is Illiquids now sort of been tarnished with a bad reputation because of everything that happened during the gilts crisis and Illiquids having to be sold. That was nothing to do with the case of the investment case for Illiquids or the quality of Illiquids. But pension schemes have sort of shied away from it. I think they're more reluctant to do that until they've got certainty everything's on what run-on could look like and the mechanisms of that. I think more clarity on the funding code and how Illiquids will form part of it is really important. Use of Illiquids in pension schemes is quite aligned to obviously what the pensions minister wants and Rachel Reeves in terms of more money in productive UK finance, because a lot of the UK pension schemes, the illiquid assets they hold, have a higher weighting to UK, more so than probably any other asset class outside of, say, buy and maintain credit.
Cool. Yeah, we're seeing that kind of trade-off between using it in sort of productive finance and then the kind of de-risking encouraged by the code in sort of other areas.
My personal view is, and I disagree quite a bit with the comments that came out on Friday from the pensions minister in terms of the priorities. I think they're the wrong way round. Pension scheme assets aren't a magic money tree to help invest in UK PLC to sort of drive growth. However, UK pension schemes, be it DB or DC, can play an important part, and probably with good quality liquids actually be investors in those products as they naturally would. But more clarity on how liquids can be used within DC vehicles, greater flexibility with that, whether it's the pricing structure or in terms of just smoothing evaluations, and within DB, greater clarity on how run-on can happen and the treatment of illiquid assets would naturally then allow both DB and DC pension schemes to have a greater proportion of assets in liquids, which generally would naturally mean they would be in UK long-term high quality infrastructure, credit, debt type vehicles.
Cool. So at the moment, your XPS thing, you've got about 5% in liquids, you said on one of the slides. So would I be right in saying you're imagining that possibly going up a bit, but in the shorter sort of duration stuff in the secondary market kind of? In
DB, yes, and I think naturally within DC as well, but there's probably a lot of work to go on within DC to have a more meaningful allocation to illiquid assets.
Cool. Thank you very much.
Thanks, Chris. We'll probably bring Henry in if he wants to unmute and see if he's got any questions, and then maybe we'll come to Con. Con is shaking his head and may have an opinion, Con. But Henry, do you want to go first?
Yeah, this is an immense enterprise. I was just chatting with Catherine Graham, who does our liquids, and she was incredulous that you'd be able to get this off the ground. What are the challenges that you're facing in getting this this platform off the ground? And you know, are you fearful it might not happen?
So we're helping clients with this in terms of it becoming a true platform where you match buyers and sellers. That becomes quite difficult because you need that pool of buyers more than the sellers. So how that morphs itself into reality, I think we're very open-minded to. But in terms of going across those three pillars and helping pension schemes through the process of getting the best price for the illiquid assets and helping schemes that we know want to have a higher allocation to liquid assets, that naturally makes this viable for us as an offering. So making it into a sort of a hub where we can connect buyers and sellers, you're absolutely right. The complexities of doing that are much greater. So we're certainly not trying to run before we can walk, and we're trying to make sure that we can do the first thing really well, and then naturally that should lead to volume and creation of something a little bit more involved and bigger.
Please understand, I'm full of admiration for you trying all this. I think it's absolutely brilliant, but you're going to need to support the industry to get it done, I think.
Yeah. Thank you.
Okay, well, we've got a comment. Nick Perrick, do you want to unmute Nick and make your point or ask your question, Nick?
Sure, happy to. Can you hear me okay?
We can, yep.
Loud and clear, okay. So yeah, so it's just a question. Sorry, I can put the camera on too, so you can actually see me. Hello, good morning. So I had a question really about the pension schemes that you're seeing, because obviously the area that you're talking about in secondary markets is a very specialist thing. I mean, some of my investors are actually selling one of their funds as an example of something to a secondary seller at the moment. So that's a venture capital fund. And obviously, there are loads of different reasons why funds do that, not just distressed assets. And in fact, I actually used to work for one that wasn't a distressed asset, that was just printing dividends year after year after year to the owners. So I think they can make great sense as investments to lots of different people. But I guess my question was more around, do you think that this is something that UK pension schemes should actually be getting involved in, just from an expertise and experience standpoint? Because, you know, I worry as somebody, you know, thinking about pensioners and the security of their assets, just what level of experience trustees in particular have on this. Or is that part of what you're saying is we as consultants need to help them better understand that?
I think that's a brilliant question. I would go one step further back as well and say, are all investment consultants able to help trustees pick the right private markets vehicles for their clients and understand the difference? And the number of private market offerings is vast, right? There are several hundred different private debt funds of various flavors, for example, different geographies, different levels of seniority with the debt, different types of assets that they go in there. Yet you will have people researching probably a very small subset of the market. Is that right? So how detailed is the research from the investment consultants that go into the long list, the short list, or just the single recommended manager in each of those asset classes? And I think that's the first important part. Are trustees being put in front of them the right and the best funds, and understanding the different risks associated with them? The second is, you're absolutely right, it's typically been the largest schemes that could do this, and that was originally because of ticket size items. So when I mean ticket size, the minimum investment. So for some of the funds, the minimum investment would be $10 or $5 million, or euros or pounds, depending on the currency of the fund. And if you're investing in, say, a private debt fund, you might want to split that across 2 or 3 managers, because a private debt fund might only have 10 loans in or 20 loans in. And just to have a large proportion of your scheme invested with 10 or 20 loans, liquid loans might not be the best sensible thing because of concentration risk. So you split that across maybe 3 managers. You then have an allocation of maybe 30 million. If you then said 10% of your assets, that means very quickly into something that only pension schemes with more than $500 million could look to invest in properly. So how can you structure illiquid assets for smaller schemes in terms of managers that can get you diversification but still access to the underlying. Again, it comes down to, do trustees understand what the difference between some of those offerings for smaller schemes and versus doing it more direct and bespokely. I think the range of skill set across trustees is really varied, depending on background, expertise, and whether they are professional trustees or lay trustees. I mean, some lay trustees in this area, because of their background, might be more specialist than from an independent professional trustee firm. I think more and more, the greater use of professional independent trustees should allow more comfort for use of things like illiquids. But again, it's a very complex area. As I said, the first port of call is the investment consultant giving the advice. Do they have the research capabilities to help put forward what is the right list from an absolute massive universe?
And probably just to follow on and answer your question a bit more, Nick, as well. I think if in answer your question, should pension schemes be getting involved in the illiquid assets? Actually, quite often what we're seeing with the trades is if we're trying to sell, it's actually been a pension scheme that's been on the other buying side, or if we've been trying to buy, actually another pension scheme's been selling to us. So it's not actually not a greater number of pension schemes getting involved in the illiquid assets. It's just a different holder. You're very right. There is the added sort of complexity that comes from the buying and selling on the secondary market, but sort of with our experience and the legal advisors, trustees can definitely do it, and it's something that they are doing right now. So yeah, it's not as if all of a sudden everyone's going into Bitcoin or some sort of far-flung asset. It definitely is just typical pension scheme investing that they've been doing the last couple of years.
Okay, thanks, Nick, for your question. Elspeth, you've put your hand up, or should I call you Con or Dr. Con? You're on mute, Con. You're on mute. There we go.
Right, finally managed to work out how to work my daughter's computer. My question is really, this doesn't actually seem to address at all the question of information asymmetries. With listed stocks and so on, we have, there are no end of rules and disclosures declined to, which basically serve to reduce information asymmetries between buyers and sellers. That's not the case with illiquids. So what does this do, if anything, to alter those information asymmetries? Because that to my mind is the principal blockage to developing a secondary market in illiquid assets.
Yeah, so a good question. I think some of the discounts to NAV that the secondary fund managers or ultimately will give on certain funds where they have good look through on the underlying holdings gives an indication of unwinding some of that information asymmetry, because they can see whether the assets are performing or not. They can potentially see which assets are distressed. Most of the liquid fund managers should have good reporting that provides some level of information, but again, the difficulty with that is the consistency of approaching that, and the source of information isn't necessarily something that can be relied upon as much as listed equities or sort of listed and liquidly traded corporate bonds. I think it's always going to be an issue with the asset class, and I don't think selling or helping schemes buy or sell things on the secondary market will ever help address that information asymmetry. I think it's part in terms of rewarded in the returns that you're expecting to get from the asset class as well. all the managers should have independent valuations and audit processes, but at times that can go wrong, and some reliance has to be placed on that independent valuation process that does occur. But it is a slightly more opaque asset class. You're absolutely right.
Hopefully that's answered some of your question there, Con, hopefully. Don't worry, Con, don't worry. We'll come back to you in a minute. Andre, another quick question as perhaps a more philosophical question is there a version 2.0 of this? And I'm thinking more generalist market. I'm thinking auto enrollment members, master trusts, SIP providers, group PP contract-based providers. Is there a version 2.0 of this sort of project? If the government and the Mansion House speech always talked about illiquids, how does the normal man, normal woman in the street get access to this sort of style, either through a default or direct? Is there a development going to happen in this space?
Yeah, so great question. In terms of how we expand it, it's probably easier to expand in the DC sense by speaking to the likes of the Australian supers, right? The way that Australian supernationals, their DC arrangements access illiquid assets is much simpler than the UK. They don't have to have LTAFs. They do it more directly by holding the funds. Very similar to what XPS has been working on in terms of challenging the thinking to say actually a trust-based DC scheme, or even a master trust if they wanted to, can hold illiquid assets within a default arrangement, and they don't need to have an LTAF. There are some advantages with an LTAF, but it's not necessarily the panacea because it can restrict you in a lot of other ways. You just need a platform provider flexible enough to do it. So absolutely, there is huge opportunity for this in terms of the transition of those assets or those liquid assets from DB to DC. And the UK has still got an awful long way to go in terms of its thinking about how DC pension arrangements, be they trust-based or master trusts or contract-based schemes, actually access illiquid assets. I think going down the LTAF route, that solves one solution, but the LTAF route potentially has other unintended consequences and limitations of platform providers accepting LTAFs from other providers as well, and natural moral hazards that creates.
Okay, cool, thanks. Con, you got a hand raised again?
Yeah, it's a different question. Thank you for the answer on information. It basically confirms what I thought. My question here is, how is this is in essence an exchange, is given away in the title. How is it regulated?
Yeah, good question. So in terms of the advice that we give on the suitability of buying and selling an asset, that would fall under sort of the regulated advice that we give. In terms of the assessment of price, I think that is more market driven. But our advice as a regulated firm to a pension scheme on the suitability on buying or selling something would form under sort of the section 36 advice that we would give schemes, and then ultimately the advice in the statement of investment principles.
So are you, forgive me, are you in essence setting yourself up as advising on all of these transactions?
No, there are other elements of advice. I think as part of our engagement, we're very clear in terms of what our advice covers and what it doesn't cover. But you're absolutely right. It's understanding who is effectively responsible for helping the trustees decide if A, in the first place, this is the right thing to do, and then B, ultimately, whether that represents fair value. We're not, as part of this, we are not responsible in terms of holding monies or payment of monies directly from sort of one party to the other. We can help sort of with the transition side as most consultancies would in terms of.
So the counterpart then for a buyer is the seller, not the exchange.
Yes.
Yeah. Okay.
Yeah, which helps on that regulatory point, and I think that within all of this as well, with the contracts involved, legal advice is really important as well.
Okay, thank you.
Okay, thanks, Andre. We've got a hand raised from Shana. Shana, do you want to unmute? Yeah, thanks. Shana, do you want to ask your question, or is your mic working? Okay, I know there is a question from you regarding the slides. Maybe that's the question, but we can't hear you. Are you okay, Andre and James, to share the slideshow with any interested party? Would that be possible? Yep. Okay. So if you could, if anybody wants the slides, please email myself or Henry Tapper, and we'll pass the slideshow on. Shani, your mic's not working. Do you want to type your question? Is there a different question to that, or is that your question? So put that in there. Before we finish, we've got 1 or 2 minutes left, Andre. Can you just expand a little bit more on price? You mentioned fixed price and performance-related price. Are there sort of rules of engagement? So for a 10 million deal, it would be X. For a 50 million deal, it'd be Y. What have you seen, and what can you say? I don't want you to say pounds, shillings, and pence what exactly it is, but is it value for money if I was a trustee or a sponsor going for your deal?
Ultimately, yes. I think there is a slight proxy in terms of size of asset. I think there are sort of fixed fees that are involved, but then there's an element of sort of the work involved in terms of negotiating, getting pricing from all the different parties. But the larger deals and ticket size tend to be a bit more involved and a bit more complicated. So there is some form of fee based on the quantum of assets or the number of funds that are being transacted.
And I think as well, just to finish on that as well, the fee, quite quick, you don't have to do sort of a whole transaction and sell the fund to actually know, is it right to buy or sell the fund, and sort of what are your objectives? So we can sort of quite quickly and quite at a low cost sort of do quite a lot of the feasibility legwork. And then the sort of advisory work in the transaction, that's when the sort of the large costs come, but that's where the success comes as well for the client when you're meeting your objectives. I was just thinking with the contacting us, we can probably put our email addresses in the chat box as well. I don't know if that is easier for people getting in touch.
Just type that in. That'd be fine. If anybody wants to contact James or Andre, then have a look in the chat. If you put your email addresses in there, that'd be great. And thank you for a fantastic presentation, Andre and James. Really, really interesting. What we like on Pension Playpen is to be innovative and hear about new things. We wish you immense success with it, and I think Henry's very excited. That was Con, I think, being excited partially. So good luck with it. I hope it really, really works well for you. If anybody wants to contact Andre or James directly, their email addresses are now in the chat. The video and podcast of today will be on the media tab on pensionplaypen.com this afternoon. And really enjoyed the session. And if anybody has any further questions, then email Andre and James directly. Next week, we have Barker Tatham talking about investment implications with the new DB funding code. So hopefully a lot of you can join the DB funding code investment implications next week. And as usual on these sessions, we pray for peace in the East and peace in the Middle East. And thank you again, Andre and James, for a great session. And be safe and enjoy the rest of your day. Hope you enjoyed today, and it's really, really good. And I wish you lots of success with it. So cheers, Andre, and cheers, James. Thanks very much.
Thanks very much. Thanks for all the questions.
Okay.
Thank you, everybody.
No problem at all.
Cheers, bye.
Yeah, good luck. Take care. Bye. Bye.